Hi everyone, this is Mr. Stocky. Recently I wrote a blog on my website on how I intend to go about maximizing my returns through trading. Please have a read of that blog if you haven't done so. It's available on my website, mrstocky.com. To accompany that blog post, I will summarize my views with this presentation and bring it to life with some examples. Before we continue, please note the disclaimer that this presentation is for information use only and is not intended as personal financial advice. What does it mean to maximize returns? It's simple. It's to generate the greatest return given the amount of capital that we have. To do that, firstly, we need to find a way to deliver a positive return over the medium to long term. To me, medium to long term means a time horizon of 1 year plus. So we should deliver a positive return consistently as possible over a 1 year period and allow the magic of compounding to grow our wealth. But positive return isn't enough. We need that return to be consistently beating the equity market. Why? Because if we can't beat the market, then we're simply wasting our time. We could instead just buy and hold the market in a passive fund or ETF and receive the market return with no effort. We would be wasting our time with resources and effort if we can't beat the market. So we want to maximize returns by delivering a positive return that beat the market. But there's one step further we can achieve, and that is to deliver that return with a smaller loss experience. Losing is part of trading. There's no way around it. But we can do our best to minimize the loss that we suffer. In the equity market, it's not uncommon to lose 20 to 30% of the value of your capital, and sometimes even 50% in a very strong bear market. We want to limit that loss to as low as possible. Why do we want to do that? Because losing is, pardon the pun, costly. It's costly to us in terms of time. Let me give you an example. In 2022, the S&P 500 lost close to 20% for the year. In 2023, the market has almost made that all the way back by delivering a 20% year-to-date return. So over that 2-year period, we've made no gain. In fact, we're still holding a loss if we were invested at the start of January 2022. That is not how we maximize returns. We must be able to deliver a positive return even in a negative period for equity markets. And we have to do that year in, year out, and allow the magic of compounding to work for us. Now that we know what it means to maximize returns, I want to show you how I aim to deliver upon my objectives. There are 3 sources of return that I want to capture in order to maximize returns. This is described in the formula in my blog post. Return equals alpha plus beta plus hedge. Alpha is the source of return derived from my skill as a short-term trader. Importantly, this return is generated in both falling and rising market conditions, and therefore not dependent solely on rising markets. The second component of return that we want to capture is beta, or the market return. But we only want to capture the upside and not the downside. In order to do this, we need to add an additional component, which is the hedge. Hedging allows us to minimize our participation in the downside and therefore avoid long losing periods in markets, which may be a 20, 30, or even 50% losing period. By being able to capture all three sources of return, we will be able to deliver on our objective of maximizing returns. Now let's go through each of the sources of return in a bit more detail. Firstly, beta, the equity market return. Why do we want to capture this source of return? The answer is this. Statistically, over the last 120 years, the market has had a positive return in 70% of those years. That is a startling statistic and a free gift from the market. I will gladly accept it. If one of our goals is to beat the market, then the easiest way to do that is to capture that return by participating in the market. Of course, on the opposite side of that is the 30% of years that are losing years. What do we do about those? Beta is a great source of return, but unfortunately it does come with the 30% of years where the market delivers a negative return. And that is where hedges come in. The objective of hedging is to avoid or minimize the downside we experience. In any given year, the market will experience losing periods. Our job is to hedge the downside and minimize our experience of loss so that we can recover quickly and to capture the upside. Hedging is an art, and it is not perfect. We can't avoid all the downside because we don't have a crystal ball to tell us what is the next move of the market. Hedging can be costly if done inefficiently. For example, if we hedge too early, we may miss out on huge gains if the market accelerates upwards. Or if we hedge too late, we capture the large losses that we want to avoid in the first place. Hedging requires skill and precision timing. This has been the missing piece of the puzzle I've been trying to solve for the last 20 years. And with the help of my short-term trading, I think I've been able to develop a hedging solution that works. But remember, hedging is not perfect, and if we mistime it, it can be costly. So is there a way to make up for some of those losses? The answer is yes. We can exploit the downside by taking short positions if we think markets will be falling. By shorting, we profit from a falling market, and the profit from that will help us to reduce or improve our return potential. To illustrate the hedging process, I'm going to use an example of the 2022 bear market. This will show how our hedging works, the ins and outs of our hedging process. Note that this is a hypothetical example, and the results should be taken with a grain of salt. I've divided the return of the S&P 500 equity index in the chart into two segments. The green segments represent periods where we are participating in the market, seeking for the market to move upwards. The pink segments are periods of the market where we expect it to fall, and therefore we want to sit out and avoid the falling market. Remember, our objective is to capture the beta or the market return, but ultimately we are only looking for the positive returns and not the negative. This was a typical bearish year where there were volatile upswings and downswings. That means precision timing is required for hedging. In this example, the hedging worked to our favor and delivered an overall positive return despite the market losing close to 20% of its value. We delivered a positive return that beat the market, and with the added bonus that our losses were smaller compared to that of the market when we were losing, simply because we avoided much of the downside. So did we maximize our return? Not exactly. Clearly, our hedging wasn't perfect. We were too early sometimes, too late sometimes, or not hedged at all. So how could we have done better to improve upon the outcome of that small positive return? Well, one way we can do that is to exploit the falling market. Instead of just hedging our position, expecting a falling market, we can short the market and profit from a falling market, thereby allowing us to generate return that lessens the cost of hedging and overall improve our return. By doing this, we can increase our overall return for the year and allow that to compound year over year to maximize our return. As we have seen in the example I just provided, beta can be less reliable, especially over the shorter term period. Sometimes we will get a big winning year and other times big losing years. We cannot solely rely on beta, even we can hedge out most of the returns. In the 2022 example, we were only able to deliver a small positive return, and that might be satisfactory for most people. But given that our goal is to maximize returns given our capital, we want to deliver much, much more. So we need another source of return. And that desirable source of return comes in the form of alpha. Alpha is the return derived from trading skill. As long as a trading edge persists, this can be seen as a more reliable source of return. As the return can be generated from both up and down market environments, there can be less variability in that return, especially to the downside. I've been developing my alpha return over the last few years, but it's been a combination of a repeatable process and 20 years of market experience and knowledge. And I believe we are at a point where that alpha is consistent enough to deliver return alongside of the beta source. So, trading skill from the alpha and also lending itself to the hedging aspect, that is the final piece of the puzzle we need to meet our objectives of maximizing return. In summary, standalone beta and hedging isn't sufficient to maximize returns. We need to make our returns more robust, so we need that alpha source to diversify our return. Together, those three elements give us the potential to maximize our return. They are the three minor mountain peaks that combine together to reach the ultimate peak in the performance we are seeking. And that is what I am trying to deliver over the medium to long term.